Planning YouTube channel, my friends. Got an exciting episode here today. Look at what I found. My book by John Bogle, Common Sense on Mutual Funds. This one was back in 1998 or 9. I can't remember. Yeah, that's Bogle's signature. I got this when I worked at Vanguard in the Camelback office in Phoenix on Camelback Road. Then they moved to North Scottsdale. I think they moved since. Absolutely, without question. If I had two books, this would be one. Actually, I got another one back there. Common Sense on Mutual Funds. I mean, this is Common Sense on Mutual Funds. Stocks for the Long Run by Jeremy Siegel. The original one came out in 1994. I think he's had 5 or 6 editions since then. If I had two investment books to recommend, it'd be those two. Probably start with this one, right? Actually, I don't know. I don't know which one I'd start with. Just get them both for sure. Again, these are you probably get $10 now, the older editions, and the fundamentals haven't changed. Now, Siegel will go into what happened in 2007, 8, and 9, which wasn't back in the 1994 book, obviously. Neither was 2001 or 2 wasn't back in the 1994 book either. But, for just basic understanding of investing, you can't go wrong. These books are absolutely the Bibles of it. You don't need a CFA. You don't need a PhD in finance. You just need some common sense. That's it, common sense. So, what I want to talk about this book, though, is interesting because I don't know if you can see this. Those are my notes. See what that says? October 2002. In my thesis, as I was taking notes, as I was reading through this book, my thesis said, need drastic change in taxation of dividends to see much increase in stock markets. As interest rates increase and people move from stocks to bonds, that will increase speculation on returns, but speculation is temporary. Fundamentals are permanent. Speculation is temporary. That was my thesis back then, and I led to writing an article in the Shenandoah Valley Business Journal, which talks about how dividends were so important, and a lot of companies had gotten away from dividends, and there's a couple of reasons why I'll get to here in a second. But it's actually pretty interesting because all the stuff I talk about back then was exactly, I won't say it came to fruition 100%, but it came pretty doggone close. And it was interesting, too, because one of the things I talk about is there's no threat of inflation. Now, remember, this is October 2002. The market had tanked. September 11th hit, tanked a little bit more. September 11th wasn't nearly as bad as what people think because the market was already down quite a bit. But back then, October 2002, there's no threat of inflation unless war heats up, potential war in Iraq or North Korea. Isn't that ironic? Or North Korea. The bonds had averaged 10 to 12% a year for the last 3 years. Because remember, Greenspan was raising rates in 1999, the Fed was, which contributed to the chaos of the market decline. Because at some point, the valuations were so high. You have incredible valuations, higher bond rates. It's just a matter of time, inevitable. I'm not going to say I predicted that. I certainly did not. When you think about it, you say, okay, there's always this rule in stock market investing, don't fight the Fed. When the Fed's raising, the price of stocks drops. And it inherently makes sense because stocks and bonds compete for your investment assets. If I can get 5% on a bond and 5% on the stock, I'm going to be in the bond because bonds are safer. As long as the company doesn't go bankrupt, and even if they go bankrupt, I might get some of my money back. Stocks can go to zero, and they do all the time. Bonds have a safeguard in there that as long as they can pay their bills, the bond owner will get paid either interest or they'll get their principal back. Again, not 100% guaranteed, but stocks have no guarantee whatsoever. Bonds, as long as the issuer stays solvent, even if they go bankrupt, you still have some rights. You have rights before the shareholders on stocks for sure. And so stocks are down 20 to 50% from highs of 2000, depending on what type of stock you had, where bonds are averaging 10 to 12% a year for the last 3 years. Dividend yields started going up from 1.5 to 2, so that's a 33% increase in dividend yields. Why was that, though? Well, it's because the stocks are going down. Remember, dividend yield is more of a reflection of the price of the shares than the actual dividend payment itself. I mean, they work hand in hand, don't get me wrong, but dividend yields being high doesn't mean that the dividends are high. It just means the dividends are high relative to the price of the stock. A dividend at $1 a share and the share is at 100, that's a dividend yield of 1%. That same dividend at $1 per share and the share is down to 50, that's a dividend yield of 2%. Nothing has changed other than the price of the stock went down 50%. So that's how dividend yields were going up. The prices are going down. So dividend yields were going down by 33%. Lo and behold, the price of the average stock was down by about the same price. Pretty interesting, actually. Not much growth in the economy at that point. Dividend yields are 2% and earnings growth are 4%. Inflation is 1.5%. Then you can expect a 4.5% real return on the markets, unless this is my big thing. Congress changes taxation of dividends. Because remember, my friends, dividends are taxed twice. They're taxed to the issuer. General Electric issues a dividend. They issue with profits. They pay tax on the profits in which to give you the dividend. When you receive that dividend, GE has already paid their tax on it, and you pay tax on it as well as a shareholder receiving a dividend. Before I think it's a Pension Protection Act, the Bush side of 2005 or 6, I can't remember. There's a tax law. It must have been 2002 because it has a 10-year sunset provision. Yeah, there's a tax bill that Bush signed in 2002. And I don't recall the name of it, actually. I'm drawing a blank what the name was. But anyway, that had the dividends were changed to taxation to qualified dividends, which are 15% for some and 0% for others. So the dividends were taxed much, much more favorably than they were previously. So dividends were taxed like short and like long-term capital gains, where before dividends were taxed as ordinary income, which is a similar rate as interest. The ironic thing about all this is when a company issues debt, you receive that debt, you pay ordinary income tax on that. Well, the company got a full write-off on that. That is right against net profits. So if a company has $1 million in net profits, has $500,000 of debt interest income that they're distributing, debt interest income, I should say, that $500,000 just comes off the bottom line. So now their net income is $500,000. Conversely, a company with $1 million in profits, they distribute $500,000 of dividends, they still have $1 million in profits that they're taxed on. So now you receive that dividend, the company paid income tax on it, you received it as ordinary income tax. It makes it very, very unfavorable for a dividend payer. And when you look back historically, when the dividends have represented such a significant share of our overall growth of the stock market, that's a big deal. On top of that, the bond interest, well, that was tax deductible because you could write it off. So what does that encourage companies to do? It gives them incentive to take on debt. In fact, even in my notes right here, let me read it to you. I said, I need to find out how buybacks have affected stock appreciation, because basically my argument back then was, unless we get a change of tax law on dividends, there's no growth to be seen, not anything fantastic. It's all anemic. The only other way for companies to increase their share price is to reduce the amount of shares outstanding, i.e. stock buybacks. And so that was my argument, that we need to find out what stock buybacks are doing, what they've done. And we've actually seen that over the last 10 to 15 years with cheap money. A lot of companies are borrowing because of interest that they're paying on the debt, and the interest rate is so low that's cheap money to buy back shares to increase their share price. That's literally what's been happening all over the place the last 10 to 15 years. Not a bad move. It's just, again, how is that fundamentally sound? Yeah, I mean, it's fundamentally sound for the shareholders today, but does it show that there's fundamental growth in earnings? At the end of the day, we want growth in earnings, growth in earnings, growth in earnings. With some dividend yield would be nice, and we're seeing mostly stock buybacks as opposed to growth in earnings. I don't know, mostly, that might be too strong. A lot of stock buybacks, let's put it that way. Then I had a note in here: research Dominion Resources to keep research Dominion Resources. That's Virginia Power. Dominion Resources will issue $1 billion in new equities to keep paying dividends. So think about that. They're going to issue $1 million in new equity as opposed to $1 million in debt. So the new equity is going to raise $1 million of cash. What does that do to the share price, though? Well, if share buybacks increase the price because you're reducing the shares outstanding, share distribution, they're selling $1 billion of shares. Well, you're making more shares out there, which is going to drop the price back because you're essentially inflating the number of shares outstanding. So the Dominion Resources was going to issue $1 billion in new debt or new stock to keep paying their dividends. So they're going to issue the shares out, which is going to drive the stock down in order to pay dividends out to the current shareholders. Now, what happens when they drive the stock down is it makes the yields higher because, again, as I said before, stock price and dividend, that has a complete correlation to the dividend yield. So the stock price drops, dividends yield goes higher, even if the dividend itself didn't change. So Dominion Resources was going to issue $1 billion in new equity to keep paying the dividend. A lot of companies were issuing bonds. They still do today to pay a new dividend because, again, the bonds are deductible. The prime that is going to drive down the shares stock price, maybe the increase in dividend yield, though, might have drew back people to buy the shares. I say, whoa, Dominion Resources now 4% yield, where before it was 2%. I don't know what happened, but that's something of interest. The bondholders, though, weren't happy because they're taking the shares, the cash from the shares they're selling, and instead of paying down debt, they're issuing it to shareholders in the form of dividends. And of course, the dividends were also taxed as ordinary income. So that wasn't good. So what happened was that we did get a pretty fundamental change in tax law, which made the dividends more favorable because, again, they're taxed at 0 or 15. I think now it's 18.8 if you throw in the Obamacare surtax and Medicare surtax there. But basically 0 to 15 is what it was under the George Bush 2002 tax law. But I want to show you something here. I want to show you about how dividends can play a role in your overall market returns. This is finance.yahoo.com. I'm just looking at right now is the Vanguard S&P 500. Does it have the ticker on here? VFINX, I guess. Well, that's what the ticker is, VFINX, but I don't see it on here. Yeah, right there, VFINX. And I'm going back from October 2002 when I wrote this book, or not when I put my notes in the book, excuse me. Wish I guess I wrote it, till the end of 2000, and I guess that's today. I'm just looking at price, point-to-point comparison. And this is one of the reasons why I cannot stand indexed annuities. Because indexed annuities, among other types of investments, off the top of my head, I can't think of any, but there are other investments that don't use dividends in their overall allocation in terms of determining how much money you get as an investor in it. So index annuities, they just use price, point-to-point comparison, and that's just horrific. So let me show you what I'm talking about here. All right, so in October 2002, the Vanguard S&P 500 was at right there, 81.87 is the price, 81.87. All right, you with me there? Now we fast forward till today, is at 243. All right, so if you fast forward till today, is at 243. Now I did some quick back of the envelope calculations here, and I said if I had $100,000 and I invested that $100,000 in VFINX at 81.87, I'd have 1,221 shares. So thus, 1,221 shares at the share price at 81.87 would have given me so 1,221 shares at 81.87 share price would have given me $100,000. All right. Now fast forward till today, I still have my 1,221 shares, but the price has grown from 81.87 to 243.81, which means the market value of those 1,221 shares is $297,000. All right, so we've gone up almost three times. We went up from $100,000 to $300,000, just price to price. That's not too shabby. So again, the price was 81.87. It bought me 1,200 shares. Now the price is 243. I still have my 1,200 shares because I haven't reinvested dividends, and now my account's worth $300,000. All right, so what happens? What happens, though, if I reinvested the dividends? So let me show you what I'm talking about. So we're going to go here, and we're going to go to performance. Now, there's no way for me to actually calculate for you on this website what the market did year over year in terms of I put $100,000 in there in 2002, what it's worth today. So I did that myself, actually. You just have to trust me when I show you. So what I did is I took the year over year returns from 2003 and I just calculated. It was up 20%, so year by year by year by year by year by year by year. And that's what I like about finance.yahoo.com. It gives you the year over year returns of these funds. So look at that. Each and every year, you see one bad year there and a bunch of green. That's what still concerns me to this day. So what do you think the net result was on my $100,000 invested in VFINX, reinvesting dividends? What do you think the net result was? Well, now, think about it. So if it's just price to price, $100,000 grew to $300,000. When you factor in year over year where you're reinvesting dividends, what do you think it grew to today? $406,000, my friends. $406,000. So I have increased my account by 106, actually about $110,000 actually when you factor in it was really 297 price to price and now it's 406. So essentially I increased my return by 33%, thus proving again what Bogle, Siegel, and all the other fundamental analysts say, that dividends represent a huge portion of overall returns, even when the dividend rates are low. So just let me end this here. I started with $100,000 in 2002. I was able to buy 1,200 shares of VFINX, which is the Vanguard S&P 500 index. At the end of 2000, well, just yesterday, is worth $297,000 because I did not reinvest. On the other hand, I invested $100,000 in 2002. I reinvested, and now it's worth $406,000. Nothing else changes other than my reinvesting of dividends. Does that not show you the value of having dividends? Does that not show you why index annuities can be painful? Because when it comes to returns, you're leaving that $100,000 on the table. That, my friends, is just a fact. In fact, I wonder if I take my trusty calculator and I say, we're going to go, bear with me just 1 second. We're going to say $100,000 I invested. And then was that 2003 to 2018? It's 15 years later. And I didn't put anything else in. It's worth $300,000. What is my rate of return? Do you see that? 7.9. That's going to be tough to see with that light right there. There you go. 7.5, 7.6. $100,000 invested, zero payment, 15 years, and I had $406,000 rate of return, 9.8. That 2% divided by 7 point. You're leaving, again, 25 to 30% of your assets on the table, of your growth on the table, because you're not getting the dividends, my friends. And that's in the years when the dividend rates are incredibly low. That's 25%. That's $100,000 that you left on the table for your indexed annuity. Now, it might be worth it to you. Frankly, I don't know what it would make that worth it to you, to be perfectly honest with you. I don't. They might say, well, you're still getting a 7.2. Well, you're not, because there's fees on top of that. I mean, don't forget there's fees on this stuff as well. So when you factor in the fees that go in these index annuities, on top of you're leaving the dividends on the table, you just can't make an argument to me that those are, I don't want to say appropriate, that they're efficient. Maybe that might be an odd word to use, but they're just not good investments for long-term growth. There's no way around that. Now, people might say they give an income, a guaranteed income. They might say there's no risk to loss. Well, yeah, but neither is a government bond either. And a government bond, after fees and the price points that we just talked about, government bond is going to sit there pretty doggone close. So this will be my argument why I'm against those things. Absolutely. And I hate to say you should be too, because everyone has a different scenario. But man, if you're leaving the dividends on the table, you are leaving a lot of growth behind. And that is growth that should go in your pocket, not some insurance company. Because don't forget, it's not just point to point where you're losing on the dividends that's affecting you. It's all the fees that go with it as well. And that's another 2% fee. You're getting essentially the equivalent of a 30-year treasury bond. And that doesn't appeal to me at all. So moral of the story, dividends are critical. Read the books, Bogle, Jeremy Siegel. I'll put links to the show notes here. Watch out for those index annuities. Someone can make an argument why they're appropriate. I'd be open to hearing it. I don't see it. I don't see it at all. So hope this helps. We'll see you next time on the Heritage Wealth Planning YouTube channel. As always, give me a thumbs up anytime I talk about annuities or insurance or any issue that people have. I'm sure there'll be people say, I got to know what he's talking about. That's fine. Argue against me. I'm open ears. I'm open to hear it. I don't see how it could be going wrong here. But anyway, thumbs up. I guess you could give me a thumbs down. That's fine. Don't forget to subscribe below right there. And don't forget the notification tab, the little bell that says be notified of future content. And comments are always welcome. We'll see you next time on the Heritage Wealth Planning YouTube channel. Thanks, guys.